All right. Hello, everybody. This is Margaret Miller. I'm very happy to have a pleasure of hosting this event today. So what we're going to do, I'll introduce briefly Xavier Giné, who's going to be presenting his work and that of his co-authors on consumer protection, and especially on this issue of disclosure versus financial literacy, and looking at the relative impact and merits of these two different approaches for helping to protect consumers. I think focused especially on Mexico and Peru, but I think with relevance for a lot of the countries we work in. So how we're going to organize today is we'll have Xavier will speak for about 35 to 40 minutes, and during that time he said he's very happy to entertain questions. If you have a burning question that you'd like to ask during the presentation, just make sure to unmute, because everybody who's not with us here in the room should be on mute when they logged in. So just unmute and then go back to mute after you asked your question or made your comment. After that, we have two great discussants. We have Laura Higgins, who's with us here from Canberra, Australia, and Laura works at ASIC, and is which is the Australian Securities Corporation Commission. But they do. I mean, in Australia, they have really interesting nationwide programs on financial literacy, including smart money. That's one of the programs that Laura is responsible for. So we're very pleased that she could be here and give us a practitioner's perspective on how you go about protecting consumers and also providing financial literacy. And then Jennifer Chen from the global team on responsible finance and financial inclusion, who's just completed the good practices for financial consumer protection, will also provide a few comments about how we can really operationalize this and work with clients. So, and then we'll have a period for questions, and I think we'll plan to be done around 2 o'clock. I know people have other commitments likely by that time, so that's the time we're going to use. So without further ado, Xavier, if you could please go ahead. We're looking forward to hearing about the research.
Excellent. Okay, yeah, so this is joint work with Rafe at CGAP and Cristina, who was working with us at the bank, and now she's at Citi. So basically, so there's been a shift in the past decades towards empowering individuals to make financial decisions. Okay, so before let's think about pensions or other financial products where before the state provided the options. Now it's more the individuals that have to make these decisions. This is combined with technology, financial liberalization that have brought about the proliferation of many financial products, and so it's expected that a lot of people will come into the financial system, into the formal financial system in the next few years. But it's basically unclear whether these individuals are equipped to make sound decisions. Okay, so consumers may not necessarily choose the best product or the one that best suits their needs. Now, why do we care about this? Because making mistakes, financial mistakes, can be costly. I mean, if basically, we know that financial markets are characterized by huge variation. Now, some of this variation has to do with differences in risk, but basically, there's been some studies, actually, including ours, that show that the same individuals around the same time receive offers for financial products with very different costs. Okay, and so you're controlling for risk because it's the same individual at the same time, right? And so then being well informed is important to make good decisions. Now, why is that? Why people might make mistakes? Well, I guess So clearly, from the consumer standpoint, these decisions have to do sometimes with unfamiliar concepts that might be hard to understand, and that's where financial literacy is going to have something to say. But from the industry standpoint, then basically, there's lack of comparability and lack of information, basically because financial institutions tend to shroud prices to maximize profit. So if we look at what's been going on in terms of revenues for financial institutions, there's been a shift from intermediation to actually fee-based fee-based profits, right? And so that should be some source of concern. Now, what have governments done is basically try to introduce legislation to improve disclosure and transparency. You know, let's go back to 1968 here in the U.S. with the the Truth in Lending Act. Mexico, Peru, Ghana have, you know, and I'm citing these countries because these are the ones where we've done research. They've all introduced similar legislations, but basically. So I guess while this legislation regulates what content should be disclosed, they leave it to the financial providers to decide the format, okay, and to decide where these should be introduced. So, for example, these are examples from Mexico. So in Mexico, they have to disclose. Product has to disclose the APR. In Mexico, it's called CGAP. And so, of course, it features very prominently, as you can see. It's basically down there, right? I mean, you basically need a magnifying glass to see it, and notice the differences in cost. Okay? I mean, so, you know, so these are two different products by the same institution, and, you know, you can end up with a product that's like 3 times, well, almost, you know, 3 times as large, right? So it's unclear basically whether this regulation has actually had the intended impact. So what are we gonna? So I'm gonna tell you about 2 different studies. Okay. The first one really tries to understand the quality of information that low-income consumers are provided when they walk into a to contract a financial product. I'm going to focus on savings and credit. We've also done this with credit cards, but for the time being, savings and credit. Now, and so I'm just going to be very upfront. So this is going to be, you know, if you will, the sort of the old, the traditional way of doing banking, which is, you know, you walk into a brick-and-mortar branch and you ask for information. That's basically, you know, according to our surveys, that's where you get most of the information, bearing, you know, the families and friends and the cousin that might tell you, oh, I bank at this bank, you should go and bank. Right? So this has nothing to do with, you know, mobile money. This has nothing to do with even agent banking. But that's something I'm actually happy to talk to because we've done also some research. Okay, so the idea is how much information, in particular, how much of the cost information of the product that you're about to contract is being provided to you voluntarily, or after you might have prompted the staff. Number one. Number two, are they steering you towards products that might be more expensive, or are they giving you the cheapest product and the one that suits your needs? Okay, so if I'm asking for a checking account, a transactional account, am I given a transactional account, or am I given an investment account, or something else? Okay. The other thing that we can look at through this interaction is whether or not financial institutions are actually complying with transparency rules. So they are supposed to disclose voluntarily the APR, YPR. Are they doing so? Okay. And then we're going to move on to another study that basically looks at whether the current disclosure forms are actually effective, or whether there could be changes in the current disclosure roles that could lead to better decision making. Okay.
Yeah.
So so how are we going to do this? We're simply going to do an audit study. I mean, this is something that's done in the industry, not necessarily the banking industry, but you know, Mercedes-Benz, you know, goes into one of these dealers and basically hires people to go out and try to purchase a car, and then they try to see, you know, what the quality of care, you know, the care of the dealership. Thank you. Yeah, so whoever sells you the car, the salesman, you know, they talk about you know, satisfaction, but also, you know, how knowledgeable they are of different features and so on and so forth. So that's being done regularly, right? So we're going to take this approach. Now, but the first thing that we have to modify is the fact that we cannot use professional auditors, because when you go and seek a financial product, the first thing they ask you is, where do you live, right? And so if I hire someone from from Bethesda and ship him to Alexandria, the guy's going to say, why on earth aren't you going to Bethesda to seek your credit? I mean, what were you doing here in Alexandria? Right? So they need to be local from the area, but basically, and also, of course, we wanted people to be, to just, be as normal a conversation as possible. Okay. So we hired local people. We trained them in different scripts. Okay. And so these scripts differed along several dimensions. So we had individuals that were looking for savings products, people that were looking for credit cards. Okay. So people looking for savings products, they either had a demand for a checking account, so they indicated they had to do several transactions, or they were going to use it regularly, or somebody that walks up and says, look, I have this money and I want to park it, I want to save it, in a sort of fixed term deposit or whatever. Now, of course, they didn't use these terms, but the idea was to see whether they gave them, like a fixed deposit type account versus a transactional account. Okay. Okay. Now, for credit, they asked for a standard loan. This was supposed to be a loan to repair the house or do something in the house, uncollateralized individual lending. About if they could ask, it was going to be like a 12-month loan, monthly installments kind of thing, right? So it just now what we did vary was how much they asked for, and they either asked 70% of household income or 20% of household income. Now 70% of household income is absolutely crazy. Okay, so now what we wanted to see here was whether banks were kind of padded the application to basically be able to satisfy the 70%, in which case these would be serious concerns, or whether indeed they said, sorry, you're crazy, we're just gonna lower how much we can offer you to something that's more manageable. Okay. Now we also varied what we call financial literacy. Okay. So the neophytes, which by the way is whatever the regular interaction of these individuals have with branches, is basically they walk in and say, if it's credit, look, I need some money to save. I need some money to repair the house or whatever. Thank you. And so what can you offer me? Okay, and then basically they let the staff talk. Okay, talk and provide information. Okay, now the experienced guys actually they basically had a set of questions or a set of concepts that they had to ask in case the staff did not provide that information. So ultimately the only difference is that the experienced guys were more engaged and asked more questions. Okay, but both were told let the staff talk, and of course the neophytes then just left. And whereas the experienced, actually they did ask some questions. But whereas the experienced guys asked a bit more questions, okay, more concepts, okay. Now among these experienced guys also, so we wanted to see whether there was some reaction to competition, and so among these experienced guys, half of them mentioned that they had been shopping around and that they had been offered some rate, and this rate was either very low or high depending on the market, okay, because we had a sense of the market, right? So the idea is, well, if I come in with a very competitive rate, what do I do as a staff? Do I try to beat it? Do I try to give him something that's better or not? Okay. Turns out this has nothing. It has no effect. Okay. So they don't react to this competitive pressure. Maybe it was too subtle. Whatever. And we also varied the dress, but whatever. And of course we have men and women. We actually, because this is Latin America, we find little gender impacts in terms of the amount of information and so on and so forth.
Of both the mystery shoppers and the credit officers, or?
So that's a good point. So I was referring now to, that's a great point. I was referring to the mystery shopper. Okay. We've not looked carefully because we do know the name of the staff, so we could. And I would. Okay, so let me come. I don't have an answer. I don't have an answer now. I don't have an answer. But basically, what I can tell you is that, by and large, all the staff behaves the same way, and in fact, behave the same way regardless of the regulatory framework. So we've done this. This has been done now in Mexico, Peru, Ghana, and also Colombia. Now, if you look at the economist, they put up some publication and where they look at the law of the text of the law, if you will. And so Peru has a very progressive regulatory framework, so they rank pretty much at the top. Mexico is around the middle, and Ghana is actually at the bottom. And so actually partly that's, we wanted this diversity to see whether, what the results were. But in fact, regardless again of the regulatory framework, all the staff behaves pretty much the same way. So first off, in terms of what kind of products are being offered? I mean, are you offered the cheapest product or the most expensive product? Okay. And so basically what happens is that people tend to push towards more expensive products. So for example, in Mexico, there's like a cuenta básica, like a no-frill account. So an account that, of course, doesn't give you a lot of yield, doesn't give you a lot of interest, but then there's no fees or commissions in terms of withdrawals, deposits, in terms of balance inquiries, account maintenance, any of that. And yet, for the 60 visits of individuals looking for this transactional account in Mexico, out of the 60 visits, only 2 were offered the cuenta básica. Okay, and given the needs, that was we were trying to Now, if you ask for it, they'll give it to you, but if you don't, they won't, right? So they give you a more expensive transactional account.
So your question, out of the 6-8 in your assessment, how many would have deserved that cuenta básica?
No, everybody qualified. Yeah, because we were interested in low-income individuals, right? So yeah. So everybody, right. So everybody qualified for that, and the kind of needs that they had. Because if you were going to transact a lot, with large deposit and withdrawal, then the cuenta básica is not for you, right? It has limits. But these are all individuals. Given the amounts, we wanted to make sure that they could have. That this was going to be the. But anyway, ultimately, so look, we complemented this audit study with a staff survey, and of course, everybody is subject to an incentive scheme, right? And so they've got quotas, and they gotta sell certain products by the month, and so therefore, of course, they respond to incentives, right? Okay, so now, so the product is not the cheaper one. It's not the cheapest one. How about the cost, right? So how about the information that you're provided about these products? Okay, so we developed what we call this transparency index, which is maybe a fancy name to say what percentage of the cost of the product are you being conveyed, right? Either voluntarily or after you've asked all the questions, okay? Also, either orally or through printed materials that they can give you. Okay, so we now whether or not they understand the printed materials is another story. But we gave them the benefit of the doubt, and if there was any information, we scanned them and went through every single piece of paper that they were given. Sorry, and so if there's any information there about the product, about the cost of the product, this was counted, right? So basically, if you're given all the information, then the transparency index would be 100. If you're given no information about the cost, then the transparency index is 0. Okay, so from 0 to 100. So how does that look? So for savings products, you're basically given, voluntarily, you're given 45% of the cost. Okay? So now, mind you, when you correlate the total cost with the kind of information that you're given, the correlation is 0. So what that means is that if I am comparing different products with information that was given to me voluntarily, I'm going to make a bad decision. Because whatever they give me does not correlate with the actual cost of the product. Okay?
So how do you calculate the cost of the savings?
Right. So that's basically so what's important here is that we gave them a profile. Okay.
So number of transactions, whether they go to ATM.
Exactly.
Okay.
And exactly. exactly, and exactly. So they had to do one or two. So we actually talk to the regulators and say, okay, what's the average guy? What is it? Now this is actually going to be important also when we talk about the next. Yeah. So because you're absolutely right. I mean, it's a tricky issue. Okay. When providing information, but in any case, there was a profile, and so we looked at so the cost was going to be if there was
a normal transaction.
Yes.
But not like penalties or fees or.
Okay. So for credit.
Yeah.
For credit, there was again 2 profiles. One of which was you missed one of the 12 payments.
Yeah.
So that So there was one where you meet all the obligations, and so that the APR would be the only thing. But the other one you also had this penalty. Okay.
Question about the methodology. Were the results reported based on just self-recall? So people would go into the bank, then they would have to sit down and write, okay, how much do I actually remember? Or is there a recording device so you could get a really true measure? Because low-income populations, when they're going in, the amount of information they can retain, there's a big disparity between that and what actually is conveyed to them.
Very good. So the question is that it depends on the country. So first off, I mean, these guys were trained not only the scripts, but also on to how to fill the forms. And they were told to, of course, what they didn't do is, pull up the questionnaire and then, just because that would be kind of weird, kind of awkward. So they were told to fill in with as much information, fill in right after the
Conversation.
Thank you. The conversation, right after. And actually, some of these were we had supervisors that actually checked that. In terms of recordings, we wanted to do recordings. In Mexico, we did recordings. In Peru, they want us to kick us out of the country. So they said, I mean, it was a very sensitive issue. Something had happened. I forget now the story, but they were adamant, no recording whatsoever. Yeah. And in Ghana, we also did recording. So in 2 countries out of the 3, we were able to do recording. But in fact, actually, in terms of recall, it was actually pretty good. So
it's okay though, because what you really want to know is what people retain and what works for
exactly.
And so
exactly.
the true spirit of it is because
exactly.
when they go home and remember what they remember
exactly.
in real life.
Exactly. So of course, in a lot of the questions they could say, look, this information was never given, or So, okay. So, now, with experience, though, the numbers jump a bit. Now, what does that mean with experience? So, with experience is the blue bar, right? So, notice actually also another interesting thing. When offered voluntarily, they kind of get the same amount of information. Okay, so the idea that the staff tailors information depending on whether the guy depending on the capacity to absorb the information of the individual, that doesn't really show. Okay, so it's not right because one of the things is, look, I'm not going to give information because the guy will not understand it, right? But even when you train somebody to come in and say, look, I've been shopping around and this is the kind of interest rate I've been given, it's not that these guys are given more information. Okay, in fact, if you correlate the voluntary information by actual levels of education, does not correlate either. Okay, so
it's like they have a set script. They're doing the script.
These guys are busy. And they see a lot of people, and they just go. Okay. Now, if you ask information, you're given the information. Okay. So with experience, the blue guys, right? When you include not only the voluntary provision, but also the information given to you, if you ask, then this jumps to 70%, right? And the same with credit. Actually, voluntarily, the numbers are a bit more dismal. But then, if you ask about the information, then you're given the information. Okay, so I guess the upshot here is, if you ask, you get information. And by the way, they don't lie about it. Okay, they give you the truthful information. But if you don't ask it, you're not going to get it. Okay, so that's the. And by the way, this is throughout now. So what you may find across countries is differences in the levels, but the pattern is exactly the same. Okay, so that they now one thing that I forgot to mention about when talking to you about what kind of products they give. So what institutions do in terms of credit, right? So if you ask for 70%, right, what they do is actually they're going to lower the money. Okay, so the guys that ask for a lot of money, actually they're more likely to be rejected flat out, but also they reduce the loan size. So these guys actually lend responsibly, and that's very good in terms of financial stability, right? So they're doing their job. So it's not, they're not creating instability. Okay. Now, what about compliance with the law? So the law says you should disclose the APY and the APR voluntarily, and that's just not happening. Okay, that's just not happening. Now, again, when you ask for it, you get it, right? So 70% get it. In the case of credit, 50% get it. Okay, when you ask for it. Now, that's not the interest rate. That's the APR, APY. Okay. Also, we asked, these experienced guys also had to reconfirm with the staff what exactly does it mean. What's the APR? What is? Can you explain to me what it is? And by and large, they could communicate it. So again, these guys are trained properly. They just they're busy and they're just not gonna voluntarily engage in a lot of information dissemination. Okay?
But just like the credit APR, 55% are not giving it. So does that mean that they were asked very specifically this question and they're avoiding answering? They're essentially
they just didn't provide it. I mean, they just didn't provide it. So there's some. We have some instances of people saying, "Oh, don't worry about the APR. Actually, all you need to care about is the interest rate," which is a complete lie. And some people just didn't even have it. Part of it, again, this might be driven maybe for Ghana and others. So in some countries, some countries this is better than others. But so just to conclude here, so the staff basically. Does not provide full information, especially for individuals that don't really engage. So again, the staff does not disclose information unless prompted, and this results in too little information provision. Okay, especially if we want to empower customers to shop around, right? To compare. Okay, and this is actually the result of this misalignment of incentives between the staff and the client, right? So basically, the staff basically has these incentives to sell them more expensive products, and so I guess when we think about regulation, we need to be cognizant of the fact that there's this player that has its own incentives, and therefore we need to take that into account. Okay. So as by way of conclusion, so I think for the first study, so I think these policies might be difficult to implement because these guys have the financial institutions might have a strong incentive to undo them, right? So I think in terms of financial literacy here, it would be it's not so much to teach folks about how to compound interest and what have you, but basically having some basic guidance on some key questions, so like a checklist, some basic questions that they should ask when approaching the staff of financial institutions. Okay. Now it's also true that maybe more effective disclosures, key fact statements, for example, could be developed and to be presented at a time when people are making decisions, not after you signed. Not after you've acquired a contract, which is actually what you do, for TILA. I mean, I don't know if you guys have purchased a house, but when basically when they give you the keys, they make you sign a bunch of stuff. Well, and then that's when you realize how much you're going to pay in terms of, how much, in accumulated interest, right? So, I mean, at that point, I don't think you're going to be looking for another lender, right? So in fact, actually, this is true. I mean, in the U.S., there are studies showing, the median number of lenders that people shop is basically one. there's just no shopping around, right? So anyway, so is there something we can do on the formats? Okay, so remember that the regulation typically tells financial institutions what terms to include in the disclosure formats, but they leave the design to the financial institutions. And these guys, so that means that they will end up with something on the right bottom, where maybe top left would be more useful. Okay. So what are we going to do? So again, we're going to try and understand the role that disclosure formats might have in financial decisions, and we're going to do this in a lab experiment. Okay. Now we do this in a lab experiment because not necessarily because it's very it mimics the real decision-making process, because that's of course not true, but it's precisely because it's not true, that we do this, right? So we're going to get their undivided attention to make decisions, and that's something that we. So the way this is going to work is we invite people in, we have a little survey, and then we present them 5 or 10 different products in a different format. Okay, these products are going to be completely made up from the terms of the market. Okay, so these sessions are going to last 2 hours. Okay, and so in each session we're going to have 30 participants, and as I said, they're going to have different rounds with different products. Okay, so they're going to be paid to show up. Okay, and there's also there's also a bonus that they can win if they make the right decisions. If they choose in every round, they choose the best product. Okay. Now the best product is basically the cheapest product. Again, we do this for credit and savings. Okay. And here we also give them a profile. Okay. Because the cheapest product may not necessarily be, so the cheapest product with one profile may not necessarily be the cheapest product with another profile. Okay. So this is where...
And does the profile stay the same through their whole experiment?
Yes, it does. It does. However, again, in terms of formats, so it matters, right? So we'll see some of the formats. Okay. So for example, so I think I talked about this. Yeah, the terms were simulated using distributions from the market. Of course, no participant received the same combination of products, and they could win more money depending on the correct answers. Now, we did this in Mexico and Peru. Because of the needs of the regulators, we tested different formats, but there were some formats that were common across both countries, and those are the ones I'm going to focus on. Okay, so we're going to have the marketing brochures, just like the ones we've seen, and I'll show you some more pictures. And we're going to have the simplified format, which is the one that we developed with sort of behavioral economics in mind, but also with the tips of the regulators. Okay. In Mexico, we also did tabla comparativa, so like a table where all the institutions were there. That was a no-go in Peru. Okay, because of course, when you think about tables, then there's 100 institutions in the market. Which ones do you put there? Right? Do you put the cheapest ones? And in which order do you put them? So anyway, it didn't work. I mean, we did in Mexico, but we couldn't do this in Peru. In Peru, though, in Mexico, for the table, we had a simple table with only key terms. We also wanted to see whether if you added more terms, then there was some sort of choice overload, and people were just distracted and confused. And we also tried one version with 5 institutions, another version with 10 institutions. Okay, to see whether if you had more institutions, then that would. Now in Peru, though, we had the key fact statement that was designed by an institution. So we tested our simplified key fact statement with a market design one. Okay, I don't know whether I have pictures of them, but okay. Now this is the brochure. Okay, and this is a simplified format. Okay, now this is for Peru, for example, the simplified format for a credit product. Now, of course, we're not, in terms of marketing, I mean, looks pretty boring, but the idea here is that all the information is always in the same place. So if I get two different products, I'm going to see the TCE, which is the APR, in the top left, and I'm going to see how much I pay in soles, in money, right? Because also there's some evidence suggesting that people don't respond to percentages as well as they respond to the actual amounts, okay? And so you see that in the top right, and that's basically, sorry, I don't know if you, so this is basically what basically matters, okay? Now here's where the profiles matter, okay? So here basically we say how much would you pay for the credit, if you pay on time, right, without any default, right? So and then this is how much you would pay if con morosidad, which is amount calculated assuming that you pay one installment with retraso, so with delay. Okay, so if you miss one pay, okay. So and then we talk about we also put the quota somewhere here because people are interested in the quota, right? Monte de los pagos. I mean that's the quota. Again, we don't emphasize this because people do care about this, so it has to be here. But really, you can have different quotas with very different, with a product that is actually ends up being a lot more expensive, right? Depending on what you pay up front or what have you, right? Again, the nice thing is that, well, first off, the relevant information is displayed prominently, and two, again, they're all exactly the same. So if I give you another product, it's gonna have these numbers changing. And of course, the name of the institution and so on and so forth. Okay. Now, for savings is a lot more complicated. Okay. So here we have these two profiles with and without activity. Okay. And now we also report how much would you need to pay for withdrawal, for deposits, and we tell them, look, you're gonna have half the guys had no activity, which means I think you do, I don't know what you do. Sin actividad, okay, so without activity assumes one balance inquiry, one deposit, and one withdrawal in an ATM, okay? And with activity, I think that you go in a teller, okay? And that's two withdrawals, whatever. I mean, this is, so we wanted, we this was done with the regulator, assuming some activity, and of course that's where also you see you see differences. Well, as you can see, so this, for example, is a product that actually yields a negative return, right? After you take into account all the right. So, and then of course with activity, that's a lot. You lose 32 soles. Okay, so but again, the issue is that you see the relevant information in a prominent place. Okay. Okay. So what are the results? So basically, these standardized formats help dramatically decision making, but for credit, not so much for savings. Okay. For credit. Now, for credit though, this is pretty impressive. So it moves from a 42% probability that you choose the right product when you're given the brochure to a 65% when you are given the standardized format. Mind you, this is the same individual, just looking at the same information in a different format. Okay? So it's the same guy doing decisions either with a standardized format or with the brochures that you find in the streets. Okay? So yeah.
So in the experiment, did the same people do both, or did different people have
No. Sorry, that's a good point. So the same individual is going to run through different rounds. In each round, you're presenting information differently. So everybody, the same guys, are going to see the brochure and are going to see the simplified format.
But with different
products, of course. Different products, okay? So, of course, the right product is going to be very different from one. And the order also is varied, right? So it's not always the case that you find they have the brochure first and then the simplified format, but actually sometimes you find the simplified format first, format, and then so right. So we varied that because we didn't want to have like learning effects within the. I mean, no, this was done following the whatever practices of credit. Of lab experiments. Okay. Now, for savings though, we don't find much of an effect. Again, and this is, we can speculate. Maybe it's because people, they don't put so much. When they choose they have other considerations than the price when choosing maybe a savings product, maybe convenience and stuff. Now, of course, this was all it's all hypothetical. It is true though that for the studies that we've seen in terms of for savings, the elasticity is actually very, very low. The price elasticity, right? So how the demand for a given product varies by price is very low. Now, talking about elasticities, we actually can compute them. Okay, and so here we have them. Okay, so this is basically by how much does the probability of choosing that product vary if the product if the price changes. Okay, and so what we find is basically that so we have it for brochures and for the simplified format. We also split the sample between those that are financially literate and those that are not financially literate. Okay, and so because in the beginning, remember we have a survey where we ask questions about, and so we ask the standard Ana Maria Lusardi questions on financial and Olivia Mitchell on financial literacy, and so we can basically separate our sample that way. We can also do it by education, but the upshot here is that if you can see, the elasticity is much larger when we go from brochures to simplified format than when we go from financial literacy to no financial literacy. Okay, so yes, financial literacy matters. So more educated individuals are going to make better decisions, better financial decisions. But the increase in financial literacy, and by the way, this, taking individuals with and without financial literacy, that's, there's a bunch of other stuff that might be different, so we should take it with a grain of salt, right? That's not a causal statement. But anyway, case, if you look at that, if you look at the difference in the probability of them choosing correctly as I vary financial literacy, completely dwarfs is the word. So it's very small. It's very small compared to just the format. Okay, just showing the format. Yeah. So again, one obvious policy, I guess, is look. Regulators should not only mandate the terms, but also the formats, right? At least, if we want to encourage comparison shopping, then the key fact statement should be given in some standardized formats. Okay, and again, I mentioned that these formats are actually more effective than the financial literacy itself. Okay, so rather than spending a lot of resources in teaching people. Then doing stuff from the supply side and making sure that the information is conveyed in a transparent way could be relevant. And of course here timing is critical, right? We want the information to be provided at the time when people are making decisions, not after the fact. Okay, so because information is provided after the fact, then of course it defeats the whole purpose. Okay. And I think I'll conclude with that.
Okay, great. Thank you, Xavier. That's a lot. It's really interesting work, and it's very, I think, relevant to the kind of policy advice that we give. So I'm going to turn it over first to Laura, if that's okay with you.
Yeah, sure.
As we're talking about practitioners, and since you're, really in a policy role in Australia, how do you, I'm just interested in your reactions both to what Xavier presented and maybe some further reflections on how you're handling these kinds of issues.
Absolutely. So I think that was a great presentation and really resonates with the work that we're doing in Australia, and I can see that playing out. There are a few things that, as far as what we should disclose and how we should disclose it, that's absolutely at work in the things that are playing out in my team in ASIC. So ASIC is the financial services regulator. So we do have that influence, on most of the organization works on the demand side, what's happening there, and so on the supply side, and we're working with the consumers to say, okay, how do we translate that message effectively? So if we're doing so, we have regulatory outcomes that we want to share. How do we get those to the right people at the right time? How do we almost immunize consumers against making those similar decisions? So we spend a lot of time translating both those regulatory outcomes, but also anticipating what might happen in the market. So payday lending is a really good example of that at work in Australia. So we have legislation that says, what payday lenders need to do. They need to have a link to our Money Smart website. So if anyone, it's timely when you're going there. But what we don't have is where they might link to the website, right? So we didn't get the how right in the legislation. So what we've done in that instance, though, is we've mapped all the payday lenders across Australia, and we know if someone's coming from a payday lending site, they go directly to a different homepage that relates specifically to payday lenders. So that's one example of how we've had to overcome exactly that problem in the legislation. We didn't get the how right, and we have a lot of work to do in that space. We're very far advanced in the financial literacy, policy agenda. We're working on our third generation national financial literacy strategy, but there's a lot of changes afoot in that space. And one of them is moving from the term financial literacy to financial capability. Sure. So I expect that in 2018, we'll be launching a national financial capability strategy, which is quite significant for us. I think the definition and the way we talk about financial literacy in our space is a financial capability definition, but there was some reasoning around that financial literacy language, and a lot of it had to do with the formal education space and engaging with teachers and in the curriculum. We've now got financial literacy education. It's embedded in the curriculum. Okay. So we're really lucky because we're really well placed to make an impact on young people, on families and communities, and really invest in that long-term behavioral change. But that change to financial capability is significant because it addresses exactly what you're talking about, not just the knowledge and demonstrating those skills to apply that, but really the behaviors and attitudes. So we are focused on some really core behaviors around improved and stronger financial capability, managing your money day to day, planning for the future, and making those informed decisions. So I think that idea of one of the key deliverables we have under that strategy is the Money Smart website, which is about information and guidance. And I think that one of the things that you mentioned was around that checklist. Yeah. We talked about that checklist of basic questions and how you do it. And a lot of our work has moved in that direction. Uh-huh. So one of the populations that we regulate are financial advisors, right? And we have some tricky things to unpack in that space. Are they doing the right thing? Is it value for money? Is it meeting people's needs? And one of the checklists we've developed is what do you think about? What do you need to ask a financial advisor, right? Preparing for that. Now, we thought, that's great. That's ticking all the boxes. What we found is we haven't got that right, actually. So there's too many questions in there. It's too much for the consumer. So people are dropping out. The people that do engage with the full checklist, because it's a toolkit, if you will, but it's a series of checklists, are very engaged, and we can follow their journey in the website and see they're going to calculators. They're really really growing in that space and engaging in what we have to offer. But there's a big bounce rate. So we have a lot of work to do in that. It's a really learning space. Right. We're lucky because it's a dynamic team. So, we chop and change things on a daily basis. And we present, different, the A screen, the B screen. We're doing testing all the time of how consumers are interacting with our material. But I've taken a few notes, and I'll be passing this on to my team because I think we have a lot to think about that we can do better in that space. I've recently been to Canada. I was there last week. So they have a National Financial Literacy Month in Canada. It's in November, and they had a conference. And one of the things that was presented at the conference is something called a Carrot app. So Canada at the moment is really having this conversation about well-being. And there is this app. So it's called Carrot, and the idea is that you sign up for this app and you are asked to do certain things, complete quizzes or engage in certain things and engage in activities, and you will to do that, you get points. You get air mile points or something like this. Points. Loyalty, it relates to loyalty cards. And apparently, Canadians are the biggest consumers of these kind of air mile points things. This is a big thing. And so what the research is telling us, they used to have to pay people to come in and participate in surveys, and they would pay them hundreds of dollars. They'd pay them for their parking, the distance traveled, etc. Now they're paying them for like 20 points, which is costing them $10. Or, it's not costing them very much. So they're saving all of this money and getting greater participation in some of these activities for much less investment. It's very interesting. So the Canadian financial literacy team have engaged in this app, and there is this budgeting. So they were focused on savings and budgeting. How many people budget, who doesn't budget, and then they focused on those people that said they didn't budget. Then they set them a budgeting challenge. You get 2 points, you do this. And they had some incredible results in that space. So I would encourage you to have a look at that. And I'm certainly going back to see how Australians engage in this point system. But it was just really fascinating, and I think I've been quite inspired by some of the things I heard there. They also talked a lot about workplace financial literacy and meeting people where they are in the workplace, because they have a very strong kind of payroll association in Canada, and that's really at work in workplaces. So that I was part of a panel that spoke to workplaces. The issue I spoke there was about building capacity in the teaching workforce. So in Australia, one of the other key programs, so we have the financial literacy strategy, we have the consumer information via our Money Smart website, and we have a Money Smart teaching program, which is in more than 70% of schools, and we have more than 30,000 teachers have undertaken professional development over the last few years. And because the teachers are mostly women, so 73% of teachers are women in Australia, and they also, we know that these are the same, this is the same group that is overwhelmed by making financial decisions, and if we can target them and build their capacity, there's some benefits for them personally, but also we would expect some benefits, for the classroom over time. So this is a really exciting piece of work, and this makes us a little bit different than what's happening in New Zealand. New Zealand's doing amazing things, doing amazing things here in the US in the financial literacy space, but their focus is more on parents. Because we have the financial literacy education, the curriculum, we talk to school communities and we talk to, to young people in that way. So it's a way for us to measure and evaluate in a different way. And we're continuing now that we're moving more online, more in that digital space. I think that our approach to measurement and evaluation will shift significantly in the coming years. But I think that that idea of what it is, how it is that we're giving them that information, how consumers are receiving that information, when is important, absolutely. That resonates with us around timeliness. But that how is something that we're working on at the moment. And as the financial services regulator, we anticipate that we'll have more and more influence around, product development, and at that time, and exactly the disclosure statements, but looking beyond disclosure, what is it, what else can we be doing in that space? And the last thing I suppose that I would mention is that looking ahead for us and what's happening in 2018 with regards to a new strategy being launched, we're trying to use, so the website, I think I was speaking to someone here who's about to launch a website in Italy that goes along with their new national strategy that they're pulling together. And they were saying, what do I not do? Right, that was the thing. And I said, well, the first thing is when you set up a website, make sure you have a plan to take things down off the website. Because we just grows and grows and grows, and whose job is it to take things down? I thought that was a very strange but interesting point. But the other thing is really where we are in Australia now, we have this website where lots of people come, but what is the impact? And I think trying to measure that engagement through the website is our challenge for next year. And we have lots of big numbers, but how long did they stay? What is the relationship? What is that conversion rate, if you will, that people use in that space? So we're starting a savings challenge from next year, and I think, there's some learning from things I've heard in Canada and some things reading from your paper, I think I'll go back to the team to say, how are we engaging with consumers in that space in a way that's ongoing, that's testing, and I think we can do more there. But it's the kind of next move. We've built a website, we have a really strong program, and now it's really, our challenge is understanding the impact, which is, as you said, extremely complicated, but I thought that was really interesting.
Thank you, Laura. Jennifer, if you want to.
Sure. So I have some slides. I can,
Yeah, sure.
So I'll try to keep it brief because I'm sure people have questions. I know I have questions about the research. But thank you also for sharing. I didn't actually realize there were two sets of research being shared, so it was doubly interesting. So I just want to, I thought I would highlight some of the resources that we have related to disclosure and transparency. And I actually thought this was just on key fact statements, so I focused on the knowledge products that we've worked on in our team, the Responsible Financial Access team that Margaret is part of as well. We've worked on some knowledge products related to disclosure and key fact statements. We also are doing a lot of technical assistance in this area because it's a very hot area of high demand from our client countries. Not just disclosure rules, but also we're actually working on developing a number of key fact statements for a range of different products: insurance, securities, consumer credit, mortgages. So it's definitely, I think this type of research will be really critical. And I agree, I think, with what both of you have said, that it's the next stage is really thinking about how to make it effective, because that's the struggle now. We're coming up with standardized key fact statements, but there's so much to figure out about where to place information, what fonts to use, what size to use, and that all has such a different impact on comprehension for the consumer. So this is just a quick introduction. So as Margaret mentioned in the beginning, we have a flagship publication called The Good Practices for Financial Consumer Protection. The first edition was from June of 2012, and the new edition is coming out at the end of this month. It's been a long, long process, but it's basically it's a very comprehensive reference. The target audience is policymakers, and there's chapters for each different subsector of the financial sector. So there's a chapter on deposit and credit products, a chapter on insurance, securities, pensions, and retail payment services. And so the good practices, it's a kind of a synthesis of international guidance as well as practices that have been effective in different countries. And it draws together, it kind of goes through different high-level principles in these standard categories for consumer protection. So disclosure and transparency, fair treatment, sales practices, data protection, and dispute resolution. But then it goes into more detail and breaks down how you would implement these principles in a country, develop regulation for it, what are the different considerations, what are the issues that you might face when implementing different principles, and then it provides some case studies. So these are the different chapters of the good practices, and each chapter covers these same set of issues. So I thought I would just include a teaser for when it comes out at the end of the month. So in disclosure and transparency, we have, I think, around 7 good practices. This is the first one that's on format and manner of disclosure, but there's other good practices on sales and advertising materials, on statements and ongoing post-sale notifications, and on notification of changes in fees and terms and conditions. But the 3 I wanted to highlight is, we have one, the first one in this chapter is on the format and manner of disclosure, and again, this is kind of a synthesis of good practices from a range of different standard-setting bodies and different research, but I think it kind of summarizes a number of things you both have said, that the timing is critical. So the timing of key disclosures, it should be established by law, first of all, and you really, really need it as early as possible in the shopping stage, because by the time the consumer goes into a branch, they've already chosen their product and they're not going to shop around. So that's one of the things that is highlighted. Obviously, we highlight plain and easily understandable language. This is a bit of a shortened version, and I think we also go into the need for local languages, so the most common language spoken in certain regions. But what we tried to do in the good practices was talk a little bit about the pros and cons for trying to implement all these, because this can also go overboard. For example, I think in South Africa, I think they tried to mandate disclosure materials in all available languages, and it was just excessive for providers. And our team is financial inclusion and consumer protection, and so that has a negative impact on financial inclusion if you are raising costs prohibitively for small non-bank financial institutions. So in format and manner disclosure, we talk about plain language, about font size and spacing, and we try to highlight that these principles should apply to all different types of communication, so written, oral, and visual communications. Then there's another good practice on disclosure of terms and conditions, and this is where we go into what are the key terms and conditions that should be disclosed in the consumer agreements, but also in other materials. And for each chapter, we talk about the specific key terms and conditions for different products. So for credit cards versus mortgages or securities or insurance products. And then we have a good practice on key fact statements specifically, because it's such a critical component of disclosure. So we talk about having them be concise and using standardized formula for disclosure for the all-inclusive APR or for the APY, because we were trying to draw together the lessons learned from a lot of different countries, and I think it'll sound familiar to you, but it sounded like there's been this evolution that you start with, well, just disclose everything that's important, and then there's this realization that's way too much information, so then you can require disclosing in a standardized format. But if it's up to the provider, it could be like 10 pages or a tiny font, and all in different formats. And similarly for total cost, APR has been, in the microfinance world, APR has been pushed for a while to replace nominal interest. But there are cases where different providers were calculating in a completely different way. And oftentimes many smaller providers don't actually know how to calculate APR or don't have the technology to do it. So part of this, one of the aspects of this is suggesting that there be standardized formulas for calculating APR and also training on how to do this for the provider. And then, of course, the key fact statement is the most useful. There's a standardized format and standardized content. We also highlight the need to ask the consumer to sign the key fact statement. And there's interesting practices. So Armenia, they told us that they put a little area initial in multiple places throughout the agreement, and they don't actually tell the consumer where it is. So it's supposed to be another check that the consumer is actually reviewing it, because again, each of these has strengths and weaknesses, and oftentimes if you just put a signature at the end, they could just sign it without reading it. So that was their little trick. And then another thing that is suggested is that providers maintain records of the signed key fact statements and be able to provide it to supervisors when they're doing their examinations. I thought I would just highlight quickly, in this new edition, the 2017 edition of the Good Practices, one of the main themes that our audience, policymakers, asked us to expand on is digital finance. And so we've woven in aspects related to digital finance throughout the Good Practices. And one of the aspects is related, of course, to disclosure. You mentioned specifically that your key fact statement didn't cover that area, but it's one that is, I think, a really big emerging area for research, how to do effective disclosure in a digital environment without negatively balancing the need for financial inclusion and all the benefits that transacting over a digital, a mobile phone can offer. So we're just starting research in this area, and I know others are as well. So I think this will be a really interesting area to follow. But I know that actually in more developed countries, there's been work on layered key fact statements in different screens. If you're transacting over a mobile phone, or using icons that flag a certain concept, because of course there's only so much information you can convey in a small screen. So the last thing I just wanted to mention, or is probably the most extensive slide, but this is just a summary of the current or past work that our team has done on key fact statements. As I mentioned earlier, it's something that's really highly demanded from our country clients. So we've worked on developing key fact statements for transaction accounts, for consumer credit, for securities and insurance, and we're hopefully going to be finalizing a technical note on developing a key fact statement for consumer credit that will come out by the end of the year. And that will talk about the different types of information to include, the different learnings about format and what's an effective format, how to implement it effectively. Often, we usually recommend that it be accompanied by broader disclosure regulations, oral communications by the provider staff. So it'll kind of comprehensively cover what a policymaker would need to consider when developing a key fact statement requirement. The other thing that we've been doing more frequently is consumer testing of key fact statements. I think that was I also think in addition to digital finance and digital disclosure, one of hopefully an area of increasing research will be what are the effective elements of design elements to consider in key fact statements. I feel like there's a smattering of different research on this, on having sufficient white space and using different font sizes and colors. But personally, I would like to see something that draws it all together, especially for a policymaker, so that they have like a toolkit to go through on these are the major design elements to consider that we know have been tested and will help have more impact. Though I realize that, and especially based on our consumer testing, part of that is very much dependent on country context. So one of my colleagues, our colleague Siegfried, did consumer testing of a key fact statement in the Kyrgyz Republic, and he found that the consumers didn't appreciate different colors because it made it seem more unofficial. Which was fascinating to me. So they thought the pure, just black and white, simple design was more of an official, formal document, which is, I think, somewhat contrary to what other countries pursue with more fancy designs and images and colors. So I think it will vary by country context, but that would also be great to know more about. Another tool that we're working on is developing a toolkit for how to test disclosure forms for consumers. And then lastly, there's a range of different work that our team does on disclosure requirements in general. So drafting disclosure requirements. We do work on developing price comparison websites and product selection websites, on designing APR requirements. And then the results of the most recent 2017, the Global Financial Inclusion Consumer Protection Survey, will be coming out probably within the next month or two. And this is a survey, it covers 140 different jurisdictions with 120 respondents. So it's pretty wide. And I think we do the survey every 3 years. And there's a range of different questions on disclosure. And the one on key fact statements, it showed that 69% of responding jurisdictions have a key fact statement requirement for at least one product for one provider type. I believe that was the statistic. And some other interesting statistics from the survey was that this requirement is much more common for banks, which I think is another emerging challenge, how to create more level playing field and have a consistent approach across different providers providing similar products. And also the key fact statement requirement is less frequent in low-income countries and also in Latin America for some reason. But there will be much more data coming out when the full survey comes out. I think I'll stop there.
Great. Well, thanks, everyone. I think this was we have a lot to discuss. Not too much time, but I want to open it up for questions from people who might be online first, or comments. If you're online, remember that you need to take mute off, because you probably are automatically muted. All right. We'll hold on for people who may be online, and we have some questions, I think, around the room. So go ahead and please just indicate your name and which group you're with. Yeah, come on over to the table.
My name is Lindsay. I'm a and these are my comments.
Okay.
So I actually had a comment and a question. So my comment is, I used to run a financial savings program, a bank account savings account program, an account opening savings program for domestic workers in the Philippines, and we had like a very similar experience. So there was like a special bank account that was like no minimum balance and only like 250 pesos to open, and nobody knew about it. And the bank, even in the brochure of products, doesn't advertise it. So much so that when we were running the program, people thought that we created a special account, and they would go to the branch and say, we want to open the account for domestic workers, because they didn't know that this account actually existed, because the bank doesn't want to advertise it, but they will give it to you if you ask for it. That was the comment. And then the question was, so prior to going back to the bank, I was working for a microinsurance startup. So it's a mobile network for low-income people for life insurance. So the pressure is the same. It's not just an incentive. Their employment depends on their quota. So they are kind of like disincentivized from explaining the whole spiel, because they might lose the sale, right? So what we were doing was we would do like quality control. So we would call the customer the day after they sign up for it, and then check what the person had told them, and then see if they can answer like at least 7 out of 10 questions randomly, to make it clear to the agent that we value what you tell them. Was there anything like that to the bank staff, like after the mystery shopper?
Yeah, no. So, I mean, some regulators that are more sort of more, I guess, aggressive. I mean, they try to, so this is all in the sphere of when you regulate on I guess sort of whether enforcement of the law, right? And so some people have advocated for putting sanctions. I mean, or having some sort of sanctions in terms of using sort of the answers to these customers. So if the regulator is then calling up recent clients and then assessing their knowledge of whatever products they've acquired, and if this knowledge is below certain levels, then the financial institution might be liable. Now, this is something maybe Laura, you might know a lot better. I don't, and frankly, but I think enforcement is a big issue. So again, you might have the best law, the best key fact statement that they should, but whatever happens on the ground is critical. And as you very well say, I mean, these guys have incentives, right? And so in fact, I mean, and there's little follow up with the actual customers. Now, customers may eventually learn that about these fees. And if you have a credit card, then you see the statement, and you realize that I'm being charged for X, Y, and Z. I mean, and then they kind of correct, right? But in other cases, you will never know. Mortgages, you will never know that you have a very expensive mortgage compared to another one, right? I mean, there's no possibility to learn. We didn't do it, and I don't think regulators typically do. I mean, I think this is a great idea, right? To follow up on a set of customers and check their knowledge. I think this is great. Now the next step would be, okay, let's use this to then incentivize or punish the financial institution themselves, right?
Mm-hmm.
I don't know. I mean,
I think this is at play in Australia at the moment. So,
is the plan? Or?
It's at play. It is happening. So I think that the incentive structure, has been challenged, and there are changes there, and there's a culture piece. What is the culture of the financial institutions? And there's a lot of challenge to change and in transparency in that place. So, fee for no service issues, banks are being kind of blamed and shamed quite publicly. So there's some significant discussion around that about what actually customers are receiving, what they know that they've signed up for, and certainly with things around mortgages, what's happening in that space as far as new customers being offered new deals, whereas customers that have been long time customers of that bank not having that same kind of opportunity. So those discussions are happening, but again, I think it comes back to people asking. I think that's the same everywhere. If you don't ask, and that's one of the big messages that I appreciate, that just putting the information out there and people having some information is not enough, but really challenging people to go back to their providers to ask the questions. Can you do better? Is this the best you can do for me today? What kind of other accounts are available? And really building that confidence to ask the questions is really at the heart of what we're doing.
I would second that too. I think for consumer protection to work effectively, it's all these pieces that have to work in tandem. The financial literacy side, but also it's not just having a law or requirement in place. There's definitely a trend and much more international emphasis on directly looking at sales incentives and seeing which may result in consistently result in negative outcomes for consumers to an unfair extent. So there's more research now on sales incentives and when it's too extreme, and also much more on the whole corporate culture and governance throughout all different levels of staff. Having this idea of treating a customer fairly built into every element of interaction with the customer, and a responsibility of all different levels of staff going up to the top management.
So I am an independent consultant, Julia Arnold. I'm an independent consultant. I just wrote a guide with CGAP on agent and employee empowerment. And so what you're saying is precisely what it will come out next month. But it's so much beyond the benefits and penalties for the frontline agent, but it's a culture shift of treating your employees as customers, and if you want them to treat your customers openly and fairly, you must treat them that way so that they can mimic that, among other things. But I had a question. You mentioned in the beginning of your presentation that you had done some research on agents, and I was wondering what that was, and then how that compared with the frontline staff information.
Yeah, so these are corresponding banking agents, basically. So as a strategy, right? So as a strategy to lower costs, right? And places where the density of branches is non-existent, then they use this. And these are shops and exactly. So what we did there, actually this is in Africa, in Senegal, and we were basically interested in trying to understand whether banking with an agent would lower transaction costs and whether that would lead to financial inclusion. So again, this is a field experiment that we did. So we looked at people that actually were equidistant between the branch or the agent, okay? And so we actually we incentivized them to open a savings account with the branch or with the agent, and then we try to see whether that led to some inertia in terms of the number of transactions and so on and so forth. And what we find is actually that those that were sent to the agent, if you will, right? So given incentives to open accounts with the agent, actually do transact more with the agent, right? But then we realized that they're still transacting as much with the branch as the folks sent to the branch. Okay, so there's overall more transactions. They definitely transact more with the agent, but it's not that they're exclusively transacting with the agent. They still go to the branch. Now, mind you, these are places where they're equidistant, right? So they can go to a branch as well. And so why are they going to the branch? Actually, this has to do with the size. Okay, so if they have a large deposit or withdrawal, they're going to go with the branch. If they have, a regular... Now, the interesting thing here is that this is not because the agent provides limits, right? And so the agent refuses to make certain transactions. That's actually not the case. In fact, the agent, is chosen properly. It has good connectivity. It has so that's not the agent. But the issue here, which is we think it's interesting, is that actually so there's a bit of there's a trade-off, right? So the agents definitely have less waiting time and better convenience and stuff. That's why they want to use it. So there's a reduction in the transaction cost. That's very prominent, and our research shows this. But basically, the agents do not have privacy. So you're making the transaction in the counter, right? This agent is the mom and pop shop that knows not only me, but knows my friends, knows my family. And so there's a concern that if I make a large withdrawal and deposit, this person then is going to communicate to people that I don't want to know. I don't want them to know what right. So in this community, in Africa or other communities where there's a social tax, basically, if I have too much money, then people are going to come knocking down my door. So whereas if I go to the teller, right, nobody's going to know about this, right? So it's very interesting how they discriminate. Yeah, if they're going to make a regular transaction, they're going to go to the agent. If they want to make a large transaction, both withdrawals and deposits, they're going to go to the branch because they value the privacy.
That's so interesting because agents are like part of the sell to banks is go to agents and get a community member that people know and trust. But that's you
but it's a double-edged sword, right? So in fact, you do see actually trust rising, and by the end line, in fact, they trust more the agent than the branch, right? There's also, again, there are more convenience, so there's lower transaction, which also means that because you have lower transactions, you're going to go more often to the agent, and also the balances actually increase with the agent, right? So these guys sent to the agent have higher balances. So they use, they follow, the dictates of a cash management model as you would expect. However, the flip side of trust is that, they can spread this information, and they don't want to. They care about privacy.
Absolutely.
What they tend to say is that usually people don't care much if they go to an agent to pay their installments because it's like, I have a debt, so anyone has a debt in this neighborhood. But if you go to an agent to save money, I don't want my neighbor or the agent to disclose that information because I'm not so sure if he or she is going to disclose it. And I don't want that person to know that I'm saving money.
Right.
Yeah.
So
you have assets.
Yes.
So we find, they do save with the agent because with that account, they could basically save, but it really depends on the transaction size. So if it's maybe in their mind, look, if it's a small transaction, then maybe the guy's gonna forget. But if it's a large transaction, then maybe the guy remembers and then the guy communicates. So it really has to do with the size.
Just two questions. One we already kind of touched on with the KPIs of the staff, whether you're frontline or the culture real large. So on that, what degree of supervisory attention is being paid simply to looking at the KPIs that sales staff of financial institutions have in some of the countries that you've surveyed, number one. So sort of the starting point to better understand what are the incentives from that side. And then number two, I was curious, knowing that the funnel of prospective clients is significantly influenced by the sales and advertising materials that are out there, to what degree is supervisory attention being paid to that? Whether it's, you see a lot of, all right, you're going to have your Schumer box or things that are sort of point of purchase or point of decision, but a wide variety of variability over the form of advertisements that people encounter. So is it usually maybe the Consumer Protection Authority that after the fact hears a complaint or sees something that's blatantly false that only then engage, or is there some interest in having greater oversight before the advertising actually hits the marketplace?
I can